Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within the world of finance. And let me tell you, our guest today, California C, has some interesting things to tell us about their recent quarterly report. Get ready for some serious financial decoding as we dive deep into their numbers. And hey, before we jump in, if you love getting the real story behind these corporate filings, make sure you are subscribed. We also have a Discord community set up, linked in the description below, where we talk through these documents in real time. Alright, we are looking at the quarterly report for Camden National Corporation, or CC for short. This filing covers their period ending the 30th of September 2025. Now, the first thing that jumps out is how much their assets have grown. Their total assets shot up to about $7 billion compared to just over $5.8 billion at the end of last year. That is a huge jump of nearly $2 billion. This massive growth was largely thanks to their acquisition of Northway Financial Incorporated, or Northway, back in January. This deal really changed the game for CASIC, significantly expanding their footprint, especially in New Hampshire. They bought Northway for about $96.5 million in shack stock, and that brought a lot of new assets and liabilities onto their books. For example, just look at their deposits, which jumped from about $4.6 billion to over $5.4 billion. That is a lot of money coming in, mostly due to this acquisition. Now, with great growth comes great responsibility, and for banks, a huge part of that is managing credit risk, which is basically how likely it is that their borrowers will pay back their loans, their provision for credit losses, which is their estimate of potential loan losses. Went from a small credit of less than $500,000 for the 9 months in 2024 to a provision of almost $20 million for the same period in 2025. This spike is largely due to the Northway acquisition and also a specific charge-off on one large loan. Speaking of charge-offs, meaning loans they have written off as uncollectible, the numbers show a big spike in net charge. Offs for the third quarter of 2025. It was 0.89% of their average loans, way up from 0.03% in the same quarter of the previous year. This was mainly due to a $10.7 million partial charge, off on a syndicated commercial loan. While this sounds scary, it is important to note that this was on a loan where they had already set aside a significant reserve. Management assures us this is not indicative of a wider problem in their loan portfolio, and their non-performing assets remain very low at just 0.12% of total assets. Let us talk about the money they made from interest. Their interest income from loans went from about $55.5 million in the third quarter of 2024 to over $69 million in the third quarter of 2025. That is a solid increase. The 9-month figures show a similar trend, with interest income growing from $160.6 million to over $203 million. Now, a good chunk of this growth comes from the Northway acquisition, which brought a lot more loans onto their books. But the increased yield on their assets also played a role, meaning they are earning a bit more on each dollar lent out. On expense side, their interest on deposits went up slightly, and their interest on borrowings went down. This is interesting because overall, they took on way more liabilities with the Northway deal. The fact that their interest expense did not skyrocket suggests they are managing their funding costs quite well, especially with the addition of cheaper deposits from Northway. Their average cost of funds actually went down, which is a win in this environment. Now, when you put interest income and interest expense together, you get net interest income, and that all-important net interest margin. Their net interest margin reported on a tax-equivalent basis increased significantly to 3.16% for the third quarter of 2025, up from 2.46% in the same quarter of last year. Even when you adjust for the accounting effects of the Northway deal, their core net interest margin also improved. This is a good sign that their core lending and borrowing activities are becoming more profitable. Of course, growing through acquisitions is not free. The company reported merger and acquisition costs of about $9.2 million for the 9 months of 2025, significantly more than the $727,000 in the same period of 2024. While these costs are high, they are expected after a big deal like Northway. The good news is that these costs are mostly behind them, with only a small amount reported in the third quarter itself. Scroll salaries and employee benefits. One center their operating expenses, like salaries and benefits, also saw a notable increase, climbing to over $59.7 million for the 9 months of 2025, a jump of about $11.6 million compared to the prior year. This is definitely a consequence of integrating Northway's operations and employees. They mentioned targeting cost synergies, which means finding ways to save money by combining operations, and we will be watching to see if they achieve those savings and if their efficiency ratio improves down the line. Speaking of efficiency, their non-GAAP efficiency ratio was 52.47% for the third quarter of 2025, which is a good improvement from 62.08% in the same quarter of last year. This means they are spending less to make each dollar of revenue, and that is always a positive sign. The 9 Month efficiency ratio also showed a significant improvement, going from 63.46% to 55.47%. This suggests they are becoming more cost effective as a larger combined entity. Let's talk about what the company is actually worth to its shareholders on a tangible basis. Their tangible book value per share, which strips out goodwill and other intangible assets on their balance sheet, stood at $28.42 as of the 30th of September 2025. This is down from $29.91 at the end of 2024. This dip is mainly due to the goodwill created from the Northway acquisition. While it might seem like a negative, it is a common outcome following a large purchase. The more important thing is that the underlying business is still generating good returns, as reflected in their return on tangible equity, which is quite healthy. Now, about liquidity, which is basically how much cash they have readily available to meet their obligations. As of the 30th of September 2025, they had over $1.6 billion in total available primary liquidity. That is a huge amount of cash and easily sellable investments. This is a very strong position, and it means they are well prepared to handle any unexpected withdrawals from depositors or demands for loans, and they have enough to cover about 2 times their uninsured deposits. Looking at the big picture, Camden National Corporation, or CAC, has made a very bold move with the Northway acquisition. It has clearly boosted their size and revenue, and early signs suggest they are integrating it well, improving their efficiency and core profitability. The loan growth is strong, and their deposit base, especially the core deposits, looks very solid, which is a great sign for a bank. However, the increase in net charge-offs, particularly that one large syndicated loan, is something to keep an eye on. Even though management seems confident about it, also, the tangible book value per share has decreased due to the acquisitions accounting, which is a trade-off for immediate scale. Overall, California C seems to be strategically expanding, and if they can continue to manage their costs and credit risk effectively after this big integration, they could be in a good position for future growth. Alright, that is our deep dive into Camden National Corporation's latest filing. What do you think about their growth strategy and the impact of the Northway acquisition? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more of these corporate explorations. And remember, our Discord community is linked in the description, so come join the conversation there. Thanks for watching, and we will see you on the next episode of Corporate Decoder.